Welcome everyone to Reverse Pitch, hearing from the investors, how Willow Growth Partners built the next generation of consumer brands, from Coterie Diapers to Bubble Gen Z skincare. With our guest today, Deborah Benton, founder and managing partner at Willow Growth Partners in the US. Deborah has brought with her two incredible and incredibly young entrepreneurs who will share how they secured investment from Willow and what that's meant to their businesses. They will also share the most important slides in their pitch decks, which is part of why these reverse pitch events are so valuable. And Deborah, of course, will tell us about her investment strategy. I'm Nancy Davis, Chief Creative Officer and Executive Director of both the Global Wellness Summit and Global Wellness Institute, and your host for today's call. This idea of a reverse pitch was born at the 2020 Global Wellness Summit, which was one of the first global hybrid events held both in person at the Breakers Palm Beach and virtually all over the world. There were a number of investors involved in the summit, and since COVID protocols prevented the usual socializing, schmoozing, if you will, which often results in business, we thought we would come up with a creative way to get some business done. We asked all of the investors present and joining virtually to take exactly 2 minutes each and explain what they invest in and what they were looking for in a wellness company. Some were interested in seed stage, some late stage, but all were very interested in opening their doors to great new ideas. It worked. We have heard from several investors and delegates about the deals that were made as a result of this reverse pitch idea. And so we thought we'd continue this throughout the year and longer, leading up to another reverse pitch on stage at this year's summit in Boston early in December. Before introducing Deborah, it's my pleasure to introduce Susie Ellis, Chair and CEO of both the Global Wellness Summit and Global Wellness Institute, and a foremost investor in wellness, both time and resources, to offer a word of welcome. Susie?
Thank you, Nancy. And what you said is worth repeating. That's what I wanted to let everyone know. It's Nancy that came up with this brilliant idea and of a reverse pitch. And we've had deals done. That happened in at the summit, which was in Palm Beach, Florida last year. So this year, it'll be on the stage again. And the investors that attend, they are also delegates. So what happens is you have a chance to meet them. And I'm sure that even more deals will be done. And so I just suggest you mark November 30th on your calendars to join us in Boston. There'll also be a virtual opportunity, but there's nothing like being there. So, but if you can make it, we'd love to have you and hope to see many of you there. Now back to you, Nancy.
Thank you, Susie. And I've already got Deborah committed, I think, to coming and being part of our reverse pitch on stage. At least I hope so. I don't have to spend much time on Zoom logistics. Everybody's pretty much familiar. You're going to be kept muted to eliminate background noise. You can choose to watch this call in speaker or gallery view and make that choice at the top right of your window. Continue to use, please, the chat function. Say hello. Tell us where you're from, the name of your company. Post a question if you like. We'll try to get to some of those. We are recording this call so we can share it, and you can all share it with your networks. You'll receive a follow-up email with a link to that and a link to the chat, which we also share because so much valuable information is always put in the chat. It's now my pleasure to introduce Deborah Benton, founder and managing partner of Willow Growth Partners. I met Deborah through Alexia Brew, co-founder and former CEO of Well and Good, now advisor to Well and Good post-acquisition. Alexia also does her share of angel and seed investing and has a connection to today's guests. And I'm proud to say she sits on the advisory board of the Global Wellness Institute. Deborah Benton has an impressive resume. She's founder and managing partner at Willow Growth Partners, and Willow provides early growth capital to entrepreneurs building the next generation of transformative consumer brands and the disruptive technologies that power them. In 2014, Deborah launched a family office investment vehicle focused on seed stage consumer brands. From 2014 to 2019, Deborah invested in 15 companies, achieved 3 exits, 0 losses, my favorite stat, and all remaining portfolio companies are active, healthy, and growing, providing significant unrealized gains. Prior to investing, Deborah held several executive level operating roles, numerous board director positions, and much more. We'll attach Deborah's full bio to the follow-up email you'll receive later today. She is actively involved in supporting and mentoring women founders. And Deborah is also very, very committed to democratizing investing. She feels that the VC world, and I'm quoting now, has been dominated by old white men controlling 98% of the capital, end quote. Deborah is working to change that. She's working to change what she feels is an elitist, opaque nature of investing and open it up to all and to transparency. It's part of what drew her here today to participate in this reverse pitch. You will find her very open, very smart, and very nice. Deborah and her family live in Malibu, California, and Jackson Hole, Wyoming, with a getaway, I think, in St. Kitts. Currently, she's in Jackson Hole, and just this week, her husband and her 13-year-old son climbed the highest of the Teton Mountains. Her 20-year-old son is interning in New York City. We always love learning a little bit about our guests, and certainly this is one interesting family. Deborah is going to openly share Willow Growth Partners' investment strategy. She's going to talk numbers, and you'll have her contact information when this call is over. After Deborah presents and we chat a bit, she's going to introduce 2 founders of companies in which Willow has invested, Shai Eisenman and Frank S. Yu. They are quite remarkable, very successful, and they will share some important insights about how they built these companies and snagged an investment from Willow. Both Shai and Frank described Deb's investment strategy as very heart-centric, more emotional than financial. This is particularly interesting, and I'm glad we're going to learn about this today. We in the wellness world talk a lot about gut health and not nearly enough about gut instinct. Deb seems to have relied on her instincts to achieve great success. Here now, please unmute, is Deborah Benton. Deborah, welcome to the warm and wonderful Global Wellness Summit family.
Wow, what an introduction. Thank you so much. It's an absolute honor to be here. And what a pleasure it's been meeting you, Nancy, and getting to know you and getting to know what your organization is focused on. It's an incredible group, and I'm so happy to be here. Nancy and I were talking about this yesterday, and I'm glad you raised this, Nancy, because it's, we're all on our own individual journeys. And when I launched Willow was the kind of the intersection of both professionally, what I really like doing and pretty good at, but also I would say equally as much were personal goals of mine, which really centered around democratizing access to capital. I feel very strongly that there is a lot of power that comes with capital, not in a negative way, in frankly, quite a positive way. I think you can instill a lot of change. But there is certainly not equal access to capital, and particularly in industries like venture capital and even private equity, access to funds and access to those ecosystems are highly biased. And we need to change that. We need to change that. And I think the onus is on the fund managers. Well, actually, I'll take a step back. I think I have a lot of my LPs on this call, so a special shout out to all of you. Thank you for joining. I think that there's onus on particularly the institutional LPs. LPs are the limited partners that fund the fund managers. And I think when there's some responsibility taken, particularly from the institutional LPs, to allocate to fund managers that look different, that come from different backgrounds, it really starts there. And it allows non-traditional fund managers to go out and have a very different perspective on who they want to fund. And I hope we're taking the step in the right direction. It seems I'm very impatient. It's slow. I think we're moving in the right direction, but we need to move a lot more quickly.
Well, you're certainly helping to move that. And I know you want to share some slides and tell us a little bit about your approach on Willow Partners and what exactly you do. So please do.
Yes, terrific. Nancy, can you see that okay?
You bet.
Perfect. So we are Willow Growth Partners. We are an early stage fund. We focus at the seed stage. So those familiar with investing, the vernacular, and you don't have to be, but if you're not and you want to learn more, there's lots of information on the internet. Wikipedia is really great. Getting a grasp on the language that's used will help you significantly. The seed stage is usually the first institutional stage, although in technology and some consumer, there are what's called pre-seed funds. Those funds generally provide financing pre-launch and pre-revenue. Again, not always, but that's if you were to categorize it generally. Willow is focused on the seed stage. We are specifically focused on post-revenue, post-launch. We like to kind of combine both operating data and metrics with the qualitative aspects that we look for. 90% of our fund is just shy of 30 million. It's a first-time fund, and we actually just closed it last month officially. If you can believe it, I have a partner, Amanda, who I'll tell you a little bit about in a second. Two women, we headed out to start our fundraise in February of 2020, which, as you can imagine, probably could not have been
timing.
Worst timing. It was insane, and we probably have raised 75 to 80% of the fund over Zoom. It's been an extraordinary year of everybody adapting. Lots of lessons there, and I'm sure at some point we'll probably write a book about it. But we are focused predominantly on consumer brands, in the health and wellness sector. I'd say if we have an overarching theme to all of our investments, it's in wellness, and wellness can show itself in many ways: food and beverage, beauty, even home and apparel. So we really focus on brands that are bringing joy to their consumers' lives, and that also have a perspective on their approach to the world and their impact on the world in a greater way. And I'll talk a little bit more about that. 10% of our fund is also on opportunistically the technology. We don't lead those rounds. We will participate in those with a strong tech lead. But generally, this is technology that's selling into the brands. The basic thesis of our fund, and I found this coming from 2 decades of operating, consumer brands, even digital consumer brands, are not tech companies. They are using tech to facilitate their operations. They're using tech to build a relationship with their consumers, but they're not SaaS companies, and we can't expect them to scale the same way, and we can't expect them to have the same capital structure or the same use of capital, or the path to profitability is very different. If you think about a SaaS company, a tech company, there's a great deal of capital upfront in R&D. They're non-inventory holding. Many of these tech companies don't build a brand. Some of them do, but many of them don't. And so why, as investors, are we approaching consumer brands with the same mindset and the same expectations as a SaaS company? We know from the exit market, whether these companies go public or whether they exit in M&A, that it's very different for these two categories of companies. And so after—
Deborah, can you just tell us what a SaaS company is?
Oh, software as a service. It's a software in the cloud, and you use it as a service. It's usually monthly expenditures. So think of Netflix.
Okay.
That is, you have a monthly subscription and you're using the services. Netflix happens to be one that's built a very strong brand, but many of these SaaS companies are behind the scenes and you've never even heard of them.
So say again, SaaS stands for?
Software as a service.
Software as a service. Okay, thanks.
No problem. So fundamentally, I had seen over many years of operating lots of blowups of beautiful brands that frankly should have withstood the test of time, should still be here today. But because of poor capital structure and wrong expectations placed on it, they ended up blowing up. Too high evaluations and way too much capital put on the balance sheet led to undisciplined spending and a focus just on kind of low integrity top line revenue growth. Really, for consumer brands, what I saw and what I continue to see is there's a phenomenal opportunity for mergers and acquisitions as an exit. We have a lot of big, interesting strategic incumbents in the consumer space. Think of Unilever, Procter & Gamble, Kimberly-Clark. These are really large, amazing companies that have a portfolio of brands within them, and they're trying to figure out how to stay relevant in today's environment as well. And so there's a healthy appetite to buy these younger, fast-growing, usually digitally native consumer brands. And here's some great examples. We saw in 2019, Drunk Elephant, many of you may be aware of it, a clean skincare brand, beautiful. Tiffany came out of Texas, scaled that company beautifully, only did one real institutional capital round with VMG, and then sold to Shiseido in 2019 for $845 million. And it was about a 6 to 7 times top line growth. Beautiful exit. Didn't raise too much capital, stayed very, very lean on the operating side, got to profitability. Just a beautiful exit. And they don't all have to be really big exits. Native, for example, in 2017 was acquired by P&G. They had only ever raised, I think, around a $2 million seed round. Grew very quickly and then sold for $100 million. These are incredible returns to both the founding team, the employees, and the investors. So when we started Willow, we really started from that mindset that we want to help companies scale. We are also very collaborative, obviously, with the founders. The founders are the stars of the show. We work with them to figure out how do they want to scale this company? What are their personal and professional goals? We just want to put guardrails on to make sure that we're doing it in a high integrity way that provides the optimal amount of optionality. Again, this is just a schematic showing kind of where we see Willow sitting. We are very early stage, which has traditionally been thought of as more venture capital. But I associate VC as very much the tech world, high speculation, looking for the billion-dollar exits. I would say our investment thesis is more aligned with a private equity approach. We're looking for long-term sustainable growth, getting to profitability probably much more quickly than a typical tech VC would want. So we kind of sit at this intersection of very early stage, but with much more of a healthy growth mindset. Just a quick, this is generally how we see our companies, not always, but when we built our own portfolio construction model, how we think about companies scaling. Again, we look for companies post-launch, post-revenue, generally $1 to $5 million in generating in revenue. It could be run rate, depending. Frank is a good example. He has a very high retention rate. He has a subscription business, so we were fine looking at run rate at that point. We like to lead those rounds, that first institutional round. That round is generally $2 to $3 million in a capital raise. We'd like to lead, we like to take the board seat. We really like to dig in with our founders and be there for them however they want us to be there. And that changes depending on the founder, depending on the needs at the time. Generally, the next round, rather than going the VC route, we generally think the majority of these businesses will find a great financial partner with a lower middle market private equity fund or a strategic. I've seen this happen more frequently than in the past, where strategics are coming down and they're structuring the deal in such a way that they're not an impediment for the company for potential exits. That can get problematic. But a lot of these strategics now have their own corporate venture arms, or they're investing right off their own balance sheet because, again, they're trying to figure out how to stay relevant. And then at that point, these young companies can get to anywhere from probably 30 to 50 million in top line revenue, sometimes more. And at that point, they could make a decision to keep going and raise a bigger growth round from generally a private equity fund. But there'll also probably be some exit opportunities at that stage. And so that's up to the board and the founder to look at the options. The key is to give these founders and these companies options and not get backed into a corner, into a very unhealthy cycle of just raising capital to focus on the top line. I've talked a little bit about this 1 to 5 million in revenue we look for. We're looking for, generally in my past, and I'll tell you a little bit about my background in a second, liquidity tends to come a little bit sooner. Again, because of these M&A opportunities, these acquisition opportunities. 90% of our fund is focused on brands and 10% on the supporting technologies. Here's our team. I'm Deborah. I spent probably 2 decades operating before moving into investing. And really, I moved into investing because I saw that it was really broken for these brands. And I didn't align with either the VC funds or the private equity funds. I liked the early, but I didn't want to go to a tech fund. And so I simply started investing off of my own balance sheet. And I did that for about 6 years with this particular thesis. And it worked. It's funny that the private equity worlds and the venture capital worlds, it's getting better. But back in 2014, when I did this, those two worlds were quite disparate and really didn't talk. It was so unusual for me. But the success coming out of that cohort of investments really was the genesis for Willow. And as I mentioned, I'm very personally passionate about getting more women and other minorities as fund managers to provide a different perspective, because I think we will actually fund different kinds of founders. My co-founder and partner is Amanda Schutzbank. She has more of a traditional finance background. She was Wharton undergrad, spent a couple of years in investment banking. She has a little bit of operating experience in a consumer hardware company, and then moved to venture capital. And she spent the last 7 years prior to Willow in venture capital. We have a couple of operating partners, Dan Nordstrom, who comes from the Nordstrom family. He built Nordstrom.com and was the CEO of Outdoor Research. And John Cochran, who is a very strong operating background, particularly in beverage and food. And here's this is my proudest slide. So spend a couple of minutes just taking a look at it. Truly, we are, as a fund and as fund managers, we are so in the background. Our brands and our founders are absolutely the stars. If I had the wherewithal at the age that Shai and Frank are at to start a company, I would have done it, but they're much better at it than I could ever do. And it's honestly, as an investor, it's an honor to be able to be on the journeys with all of these founders and brands. So that's Willow. I hope that gave you a good overview of who we are and what we focus on. And I'm sure we'll get into some more questions later.
Yeah, Deborah, that was incredible and very informative and very interesting. Is there an average number of years that you stay with a company before you exit? Is there any kind of, is it vary company to company?
Yeah, it really varies. I see my job as a guide and to be as helpful as I possibly can to the founders. I invest in these companies because of the founders. It's so early when we invest. It really comes down to the founders themselves. We always have a discussion about their hopes and dreams. It doesn't mean anything is set in stone because things change. There's so much variability. What I can tell you is from my individual portfolio, I had an exit after 1 year. Time bought a media company, Hello Giggles, a very female-focused media company, after 13 months. That's probably pretty unusual. I had exits coming out on secondary. Secondary just means when there was a larger growth round being done, some capital went onto the balance sheet and some capital bought out some early investors at both 3 and 4 years. I think in our model, we have modeled out sometimes coming out on secondary, but generally it's probably going to be a 5-year hold if it's through to liquidity. On average, that could range from probably 2 years to 8 years.
Okay, that's great and very, very helpful. And there are a lot of people asking, you know, how they would approach you and get in touch with you. And so we will be sharing Deborah's contact information. She is open to hearing from you. Anything you want to say before you introduce your founders there? Is there anything you'd like to tell people who might want to be in touch with you about potential, anything they should know or prepare or do to reach out to you?
Yeah, I'm on LinkedIn. Also a great way to just take a look at my background and connect. I'm actually it's probably the platform I use most on social media. I actually like it a lot. There's one other thing I'd like to just touch on with our investment thesis, and I very lightly talked about it earlier. We are a fund, we're very values focused. So when we look at prospective investments, we obviously look at the integrity of the financials that we can look at. We spend a lot of time with the founder. We want to back founders and companies that are launching and operating through a lens of their own values. It can be a lot of things. I'm quite agnostic. For example, Shai's company is focused on clean, non-toxic skincare, which is great. We're very cognizant of, from a health and wellness perspective, the ingredients that we use. But even more excited for me was the fact that she is making this offering at accessibly priced. She's democratizing access to, you know, what has really been pretty prohibitive from a pricing perspective in the past. That was very, very exciting, and the demographic that she's going after. Frank as well, he launched his business through a lens of health and wellness as well. The most absorbent diaper on the market, water-based wipes. There's a component of sustainability in there. These are all very important elements to us. And if you look at our brands, that last page that I showed up, you can go one by one by one. They all have their own particular lens that they look through. But they're bringing a positive impact to the world over and above just the products that they're putting into the world.
It's wonderful to see somebody really, truly, putting their money where their mouth is, using your company and your vehicle to make that change. I think because we're halfway through this call, I'd love you to introduce whomever you want to go first. And we'll let them tell their stories, because that's really, really interesting and a good example of what you've done and how that has worked for them.
Awesome. Well, again, these are the stars of the show, the founders, absolutely. Shai, I'll start with you. So Shai Eisman, incredible founder and CEO of Bubble, which is a clean, non-toxic skincare line focused on Gen Z, and particularly on teens, which was a completely underserved market. She'll talk more about that. I'm not going to take it away from you, Shai. Let me hand it over to you, and you can tell your story a lot better.
Sounds good. So thank you. And thank you for inviting me to be here. I would say that Deb and Amanda and also Alexia, who's here on the call, have done so much to kind of support, and also Elisheva to support the business. And they've been such a huge part of this journey. So Bubble is here to reinvent what young skincare means. I'll share my screen and then you guys will be able to see a little bit more. So we started working on Bubble nearly 3 years ago, when we realized that even though teens today and young people today are the most advanced generation that ever existed, I don't know how many of you kind of research Gen Zers or are spending much time on TikTok on a daily basis. It is a very, very, very different world. So what we realized is that even though they are so advanced and so different and have so many different values, they still use exactly the same old school stuff that I've used as a teen and that my mom used as a teen. So they're still using Proactive and Clean and Clear and Neutrogena and Cetaphil. And what is really interesting in Survey, and what is really, really interesting of all these brands is the fact that they are not emotionally connected to them. So most millennials you would talk to will tell you that they're obsessed with their skincare routine and that they love the brand that they're using. But most teens, they just use whatever is accessible to them. And most of the products and the ingredients that you use are actually over drying their skin. And that they tend to say that they're clearing the skin, but they're filled with so many bad ingredients, drying alcohol, and lots of other bad stuff, formaldehyde releasers, that just you don't want your young teen to be using. So we created the brand to really change that. So I'll jump quickly just to show the product, and then I'll share about the whole thesis and why did we start this. So these are our products. Our average price point is $14. The brand was launched D2C only 7 months ago. And a week and a half ago, we've just launched in nearly 4,000 Walmart stores across the US. So it's been a very exciting time for us.
And
the goal-
DTC is direct to consumer, right?
Yes. So we were
Okay.
online only. We didn't have any Amazon presence. We didn't have anything besides our own website. And then we decided, after lots of conversations with different retailers, we decided to partner with Walmart in a very exciting launch that just happened a week and a half ago. So we're still kind of in the middle of the mess of it. But the whole goal is to really reinvent the skincare aisle, to give young people something that is higher, better quality, and actually the best quality possible. Deb is actually using our products despite the fact that they're made for young skin. So really create something that is so much healthier, something that is better, but something that they will be right for their values and will be something that they'll be excited to use, and something that will truly get them to use their products, because a lot of teens just don't remove their makeup before they go to sleep. We are also in the process of developing different things that are around sunscreen, and really kind of improving specific conditions. All the products are working to clear the skin and are made to treat acne. So just to go through a little bit of the slides and the key things that I would say that were the most important to us in this journey in building the brand, but also kind of in partnering with Willow Growth and with other investors, is truly explaining the difference of Gen Zers, and how different they are from other demos, and how they're all about gender neutrality, and they're all about being super socially responsible, and being authentic and being real. And this was something that most investors that I've shown them this slide looked at me as like, who are these people? But every teen, I would say definitely in the US, but probably in the world, would know each and every one of these people and will tell you exactly who they are. And this is just something that we always started with to explain the gap, and of how much this generation is different. And this generation is something that, most investors haven't really dealt with, and haven't really, and most brands don't really speak to, because they don't understand. There are over 100 skincare brands for every skin type over 25. It's option overload. When you start looking at price points of $25, $22, there are so many different options. But when you start looking at much more affordable options and targeting younger skin, there is nothing. So this is what teens and young people today are using, products that I think a lot of you will know and a lot of you have seen before, and that every teen who's using them will tell you that they're probably not emotionally connected to these brands. They don't love them. And most of them would actually not even know what they're using. So teens are really stuck with a handful of drugstore brands that their mom used 20 years ago. One key thing that was, I would say, the biggest and the most important to us when it comes to building the brand, and it took us over 2 years to build a brand, and in the fundraising process, was the fact that we started everything with research. Research was everything to us, and it still is. Like, we still conduct research every two to 3 months with our consumers to really get an understanding of how our things changed and how they evolved. And we have a community with thousands of teens and thousands of brand ambassadors that we constantly research for every decision we make. And this was something that I would say Deb can talk about that part. But it was incredibly important to really explain that we've done our homework in this industry and that we know exactly what teens are using, what they're unhappy with, and how are we going to tackle these issues and really improve them.
Shai, I just want to say, I think this is one of the most important slides, and a really important point, which is that research, market research, really drives what you do. No doubt, the success that you have had, and it's so important in everything. I mean, we are huge believers in research in our world, and clearly this has really underscored what you've been doing. So I just, really think it's important.
I would say there's so many different things that have been a part of this journey, but I would say the one key thing that we know that we can attribute everything to is the research that we've done, because we started off in late 2018 with conducting focus groups with hundreds of teens before it was Bubble, before we had a name, when we just bought 70 different products and let teens try them and ask them what they think. And suddenly you hear about a 15-year-old from New York who never heard of Drunk Elephant, which is something that you would never think that exists. So we've learned so many different things that I would say that we're completely different than any assumption we've had. We've had so many different assumptions, and all of them, without a doubt, were wrong until we conducted all this research. So the fact that we saw this in the beginning, and specifically with our consumers, but I would say it's with every consumer, things are changing on a regular basis. Our consumers is definitely faster because, as you guys know, 15-year-olds move pretty quickly. But it's still like in order to keep up with them, we have to research our audience all the time at every given day.
And just define your audience. Age is?
So we're expanding it. We started off saying just teens, and then we got into a point, and this was also a really big part of the learning curve, because we got a lot of 21-year-olds coming to us and saying, oh, so I'm not supposed to use your products. So now we talk about young skin, which we would say that it's 13 to 25. I'm 29 and I'm using the product, so it's not that older people cannot use the product, but
You're so old, Shai.
No,
I'm,
but
I'm 29 and I'm using the product. So
my mom's
I'm
using the
29
product
and I
as
will
well.
use the product.
The products are truly, we've worked with dermatologists and product developers for more than 2 years, and chemists. We have a dermatologist in the team to formulate the product. So the formulation was incredibly important to us, and we've done tons of research. But there are great products out in the market. It was extremely important to us to understand how to build the brand in terms of the positioning and the messaging, and how to make it truly about clearing and balancing the skin. And most important of everything is, how do we make it truly accessible? Because for me, my constant assumption is that $20 will be a great price. For teens, $20 is a lot of money, because when you think of spending a full routine around $60, that is very, very expensive.
I'm going to just, with an eye towards time, forgive me, I'm going to move you towards how you got the investment. What was important to get the investment, because then I want to give Frank his due, and his time on this, and have a little bit of time for conversation at the end. So if the products are incredible, the packaging sustainable.
So the packaging, we have a recycling program, which we've launched with. We fully subsidize the recycling process, and we allow all our consumers to recycle their products.
Okay.
So in terms of getting the investments, we've had, specifically, I would say with Deb and with Willow Growth as a whole, it was a lot about the consumer connection and emotional connection to the brand. When we talked about emotional investing choice, I wouldn't say that it's emotional in terms of the choice of the company or the founder. It was around, how does the brand truly speaks to the consumers? What is the unique point of view? And how do you do it differently and truly create that emotional connection? Because there are a lot of companies out there. There are so many companies. I have friends who built incredible companies generating tens of millions of dollars in revenues a year, but they haven't built a brand. They've built very performance marketing driven companies, which is very, very different than building a brand that your consumer will love and will be excited about and would want to use you every day and would want to repeat or constantly purchase it. So yeah, sorry, go ahead.
No, so I mean, it's really, it's a company with a purpose and a soul and a message and a connection to consumers, to their audience that really drives you, and it seems to drive Deb's investment strategy, that it needs to have that component. Thank you so much, Shai. There's so much more. I mean, there's so much more to learn from all of you, and surely we can try your products, even though we're not necessarily in the correct age range. But I think it's maybe we will pivot now, Deb, and I'll ask you to introduce Frank, and we'll go from skincare to baby skincare and the world of diapers. And I can't wait for the market research on this.
Yeah, and Frank's another one that did amazing research, years of research. So I'm very, very honored to introduce Frank Yu. Frank is the founder and CEO of Coterie, the best diaper and wipes on the market, and soon to be a broader assortment. Willow led the seed round in May of 2020, and Frank's been on a rocket ship ever since. Frank, let me hand it over to you.
Thank you, Deborah. Thanks, Nancy and Susie. It's a pleasure to be here. Thank you for having me. I introduce myself as a diaper engineer nowadays, and I want to tell you why I started Coterie. And there was a lot of research involved, but it's a little different. It's not consumer-facing research, but it's market research. I was inspired by the Japanese around 10 years ago. 3 companies called Goon, Mary's, and Mooney. They woke up one morning and had a really simple but brilliant idea, which was the diaper is not a commodity. They decided to build a softer, more absorbent diaper because they knew that the parents needed it. Most parents are sleep deprived in the first 6 months, and that product solves for that big issue. They launched a product in 2010 and created a premium diaper category in Japan. In less than 2 years, they had 45% of the market. They were smart enough to export the product into China, and in less than 5 years, by the end of 2017, they basically kicked P&G out of the market. They took 23% share in China one market, despite charging a slight premium. And that really told me that the trade up trend is really real in baby care, because it's human nature to provide what, if you have the means, you buy the best for your children, and that's universal. So that trend came over to the US, with the Honest Company as well back in 2011. I'm no Jessica Alba, but we have better engineering. They were able to create a niche in the market. A pretty big company just went public, right? With a mission to provide sustainable products. We're a little different. We understand that the most important thing is to create a diaper that doesn't leak, doesn't give your baby rashes, and lead to better sleep. And that's what we did. We spent 3 years in the lab before launching the company. We started back in 2016, so it's been 5 years now. I can't believe it. And we launched in 2019, 2 years ago. And now I'm going to share my screen now to give you a bit more context to where we're at. So Nancy asked us to share, what worked in fundraising. I think one of the things that if you have a track record or testimonials or recognition, it's important to show social proof early on in your presentation. And when Deb invested a year, 15 months ago, we don't have this, right? So it took a long time to build the award slide, similar to Deb's portfolio slide. It takes a while to get here, but this would really help, build credibility early on, that connection with your potential investor. Another slide to show you is, how good our diapers are. It's a product with true technical and functional emotional benefits. It's a product that is 2 times more absorbent than market leaders, 3 times drier, and 3 times quicker in terms of speed of acquisition. A product engineered to eliminate leaks and blowouts, lead to better sleep, and eliminate rashes. So those are very, very important skin and health benefits, and not to mention the peace of mind, the psychological effect on the parent. It would be also good to introduce the problem early on in your pitch to your audience. And the best people introduced is really, really early on. Frame the problem in a very consumer-friendly way. things that you would be able to understand. Early on, Deb does not have any data, right? We're so early. The good thing here is that her partner, Amanda, has been a Coterie customer for over 7 or 8 months. So that was a big, I think, a factor in Deb's decision to invest in Coterie, because they know that the product really works. The product speaks for itself. And Amanda had a newborn, I think 6 or 7 months old back then, and she was experiencing going through the the sleep deprived 3 months. Yeah. And she understood what we're trying to solve for. So I'm going to spend a couple of minutes talking about 3 really key slides. These are going to be more technical than what Shai was describing, but it's important to get into a meeting with these materials prepared. By the way, quick comment on pitch decks in general. It really, it's not the most important thing. I think it's really important to do the work, prepare a good pitch deck, and go through the process of learning what to say about your thesis, and articulate what problem you're trying to solve, and articulate the track record that you have. But usually the way it works is you send the deck ahead of time, and a good presentation gets you the meeting. And what really sells is yourself and your passion behind what you're trying to build. So that's really important, but it's really important to do the work, know every single number that you're showing on the slide code. And this is where I typically start. So the good thing about selling diapers, the fundamentals of the business is really, really good. It's really attractive because you need to use a product for 3 to 4 years. And it's a sort of we're hunting down the share of wallet, essentially, because every parent is going to spend on diapers, and they spend a lot of money. Our diapers are slightly priced above the mass. We're adjusting the price point. It's not optimized yet, but it will be slightly call it in the masstige realm. But we launched subscription around a year ago, and a typical subscriber at Coterie, this is factoring churn and retention, a typical subscriber spends $1,000 US with us, and that's pretty impressive objectively. A typical Coterie customer spends $640 with us in a year. This is only in 12 months. So highlighting the fact that you have a really high LTV, lifetime value, is really important. So a lot of people ask me, what is the job of a early stage CEO? And the answer is this: it is to grow the company as quickly as possible while maintaining a really good LTV CAC ratio. LTV CAC ratio is your profitability. So the growth at all cost model does not work. That was direct to consumer 1.0, Warby Parker early days. That was the Caspers of the world. That worked. But today it doesn't really work. Your bottom line needs to show results as well. And that's what's really important with a good e-commerce business is my job is to maximize the LTV CAC while growing the company as fast as we could.
Frank, is your company direct to consumer online only? Are you in stores?
We are 100% direct to consumer today, but we will be in high-end groceries starting next year. So just a couple of subtle things. We're putting pretty well-known brands in the U.S. on slides so that it subtly conveys to your potential investor that we could one day be as big as these guys. And these are household names: Sweet Green, Glossier, Ritual, Everlane. These are billion-dollar brands, female-focused brands, and hopefully Shai and I we'll both be there one day. But just to show the comparison here is a good good way to show that you have potential. The next slide, a lot of early stage investors will look for a sign of community, and that's probably one of the most important things that early stage investors look for. It comes in many ways. So for, I guess, Shai's company, you would look for engagement on social. You would look for virality, how many times your TikTok post has been shared around. And there are many platforms that would help you track the virality of your brand. How many people have posted about you on Reddit online to talk about you in dark socials, right? That's actually a really good way to do research on the brand that you're about to invest in. And to institutionalize that metric we use NPS internally. It's called, it means Net Promoter Score. I'm sure a lot of you here understands what that means. It means how likely, is a customer to refer your brand or product to your friends or colleagues. And I think, again, I suddenly put some big brands on here. So just to show that your investors that, hey, we can one day be that big. But Peloton has publicly said that their mission is to be the first company or first brand to have a perfect NPS score. And their target is to deliver 99 at all times. And that's really, really difficult. We conduct a survey after every purchase, and we know where we stand because they tell us where we stand as a brand, how we're doing those CX operations, post-purchase, pre-purchase, everything. So we get that feedback with every purchase. It's a voting mechanism almost. And it's also good to, on the slide I showed you Pampers and versus us, we're competing in the same space, right? And our NPS, our Net Promoter Score, is almost 3 times that because we have a direct relationship with our customers. So that's, again, a very unique point. So community, early signs of engagement, these are very, very important metrics in the early days. And finally, every good pitch deck needs to have a good team slide. And it's really important, people, Deb talked about the difference between a venture firm and a PE firm. You would think, the venture guys are more, risk taking, but in fact, everybody, PE, VCs, everybody's looking for, patterns, previous history that indicates future success. And, it's really important to show them that we have a group of people who have, done it before. I have a finance background. I'm the only person on the slide, among the core team that hasn't scaled a company from 20 million in revenue to 100 million plus in revenue US dollars. And it's really important in the early days. It's really important to show your investors that you're able to recruit and sell people the dream that, this is going to be a great business. If you can't, that's going to be an issue. So you first have to sell people, your partners, your colleagues, that this is going to be a big thing, and get A players to join you, even though there's nothing yet in the early days. So everybody here, there's Uber, Away, Primary, Lola, Bonobo, Slice. These are bigger brands that have gone public or been acquired, and they're relatively successful. And it's important to show people that we have a good team for this stage of the company. And this is the bonus slide because I was told that we should share 3, but it's really important to show that it is a big opportunity. It is a big opportunity. We should all tackle big problems, and that's what's attractive to investors. But take the diaper space, for instance. Globally, it's at 88 billion US dollars, massive. But that's not the key thing. The key thing is understanding among this big market, which segment you're going after. For us, we're going after the masstige, call it the top 20% or 25%. So that's 16 to 20 billion. And a typical Coterie customer looks like this. She's 33. She's either both urban and suburban, but she's college educated, sophisticated, usually a working mom, doesn't have 3 to 5 kids. They have 1 to 2 kids. And they make above average household income. And you need to know your audience so that you can go after them. But it's important to paint the picture that, hey, we understand who our customers are, and that there's a big, total addressable market for it.
Frank, do you have a baby at home? Was any of this inspired out of personal need?
That's the interesting fact about me. I'm not a parent. So I actually tackle, the diaper space from a really, I saw it as there's been a lack of innovation for 35 years, and that's how we come in. So I have a very, first principle approach to diaper and engineering. And I think because I'm not a parent, I cannot assume, and that's Tushai's point. I have to go talk to parents. Hey, what matters? I have to do a lot of, surveys and research. Tell me what matters to you, and I'll deliver.
Frank, you can stop sharing. Thank you. Stop sharing your screen. That would be great. This is this is like an MBA in, I would say, in how young brands approach building a business these days, building a brand. I mean, this is a really interesting and very different, I have to say, for our audience. I think we have looked traditionally at older brands and different kinds of consumers, different kinds of audiences, making this particularly a fascinating conversation. And it seems like there are certain things like knowing your audience, having a purpose to what you're doing, and in real engagement with people. This is not, you're not just making the next, sort of best widget. I think it's really quite incredible. Alexia Brew, if you are on this call, and I am not looking at all my pages of people, but you might just, if you would unmute and just let us know about your involvement in this, or what you feel, because you're very connected to the younger investing community. Anything you want to add?
No, I mean, these were phenomenal presentations. I think, I was so blown away by Bubble, and I think it'd be interesting to hear Deb talk about sort of what, she was saying earlier, they typically join post-revenue and post-launch. I know Deb got so excited about Bubble that they actually invested earlier than they usually do. I know for me, seeing her vision around the brand, she actually let early investors on the community that she had of 4,000 Gen Zers. And so I got to actually see the engagement and the level of conversation and, just the quality of research that she was doing. So those things really blew me away. And again, and the price point and just knowing the need.
Yeah, thank you, Alexia. Yeah, it really is. It's quite a story. I mean, they're both incredible stories, but I have to ask, Shai, how on earth did you get into Walmart, to 4,000 Walmarts? I mean, we've got like 2 minutes left, but that, I know how hard that is to do. I have worked with other companies and brands and licensing. It's impossible. How did you do that so quickly?
So I would just say first, I've shared in chat the best platform for market research for everyone. If you guys want to check it out, it's something that I would highly recommend. But in terms of Walmart, we were very fortunate. So we expected to be in retail in 12 to 24 months after launch. But we never expected them to reach out to us so quickly. So we were very fortunate that pretty much most retailers in the US reached out to us in the first week after launch. Which we were blown away by that. We never expected that. And we researched heavily each and every one of them to understand who's the best partner for us. And Walmart is an unbelievable partner. They are truly now understanding how it is to work with new brands. They created these different programs to really support brands. And they finally really get it of how to work in a way that matches the profile of these brands. So they're definitely are making a huge difference in the industry. And I'm sure you guys.
And what was your stat about how many Gen Zers shop in Walmart per month?
So 41% of teens actually go to Walmart at least once a month, which we were blown away by that. So we've done tons of research in the decision of which big box retailer or prestige beauty retailer to go with. We've done research as well. So we asked about 2,000 teens, where do they go? Where do they shop? And we realized that even though they are in Walmart all the time, there's a really incredible opportunity to create something different and a much better offering for them there. And this is going to make us truly accessible to 90% of the US population, not only urban areas. So
we pride ourselves on ending on time. It is 11 o'clock. This has been an incredible, fascinating, and fast hour. I will just give Deborah the last word. Anything you would like to say before we all unmute and give you some love?
No, I mean, look at these two founders. It doesn't, you just listen to them, you can completely understand why we invested in them. And it comes down to the founders. For aspiring entrepreneurs, passion, tenacity, it's going to be a really hard road. You have to really wake up knowing that you have to do this. But if you have that feeling and you have, discernible and differentiated approach and an unfair advantage, I'd say go for it. We need more innovation.
Thank you so much. Thank you, Shai, Frank, Deborah. Thank you, everyone. Everyone, please unmute. Let's give them a little global love. You all receive everybody's information, the chat, the recording of this. Absolutely fantastic.
Thank you, Nancy, so much.
Thank you so
Shai,
much.
Frank, thank you.
Thank you, and thank
you.
you, Alexia.
So much. That was amazing.
Absolutely
you.
wonderful.